Hello friends, welcome to Learn-Easy. We will discuss swap in derivatives market. Let us see what the derivatives market is. The derivatives market refers to the financial market for derivatives. Derivatives are financial contracts whose values are derived from an underlying asset like commodities, currencies, stocks, bonds, interest rates, etc. They are used for various purposes including hedging against risk, speculation on price movements, and facilitating arbitrage opportunities. India has active derivatives market in equity, commodities and currencies. These markets impart liquidity and price discovery to the underlying cash markets. It allows parties to trade specific financial risks such as market risks, credit risks, etc. Types of derivatives are: first, options; second, futures; third, forwards; fourth, swaps. Our topic is swaps in derivative markets. Swap markets refer to over-the-counter OTC market where counterparties exchange financial instruments known as swaps. A swap is a derivative contract where two parties agree to exchange financial flows at certain intervals during the life of the swap. The main uses of swap markets in India is for corporates to hedge interest rate and currency risk on foreign borrowings. Swaps help convert floating rate loans to fixed rates or vice versa. Banks trading swaps earn fees while facilitating client hedging needs. Swaps also allow speculators to bet on the direction of interest rates and currencies. Features of swap. First, these swaps call for a trade of cash flows or different types of financial instruments, as for example bonds, which must comply with the detailed arrangements and conditions established earlier. Second, ordinary swaps categorized as interest rate swaps, currency swaps, and commodity swaps are among the common ones. Such as interest rate swaps, the former somehow involves changing floating interest rate payments for fixed interest rate payments and vice versa depending on the context. Third, the process of modern currency swaps is the conversion of the main amount and the interest payments from one currency to another. This can be done by including terms like the principal amount, when and how frequent payments are made, and dates of payment maturity. If you find the topic interesting and helpful, do subscribe my channel and press the notification bell. Now, example of swap. Firm A has raised rupees 1 million in debt and pays a variable rate of interest, currently 5%. On the other hand, firm B has also borrowed rupees 1 million in debt but pays a fixed interest rate of 6%. Now, firm A is apprehensive that the interest rates may rise soon, while firm B intends to take advantage of the current lower floating rate. As such, both companies enter into a swap contract under which firm A will pay the fixed interest rate 6% and firm B will pay the variable interest rate 5%. At the start of the swap, firm A will have to pay 1%, that is 6% minus 5% of the debt to the firm B as the difference between the two interest rates. However, if the interest rates fall such that the variable rate becomes 4%, then firm A will have to pay firm B 2%, that is 6% minus 4%, as the difference between the two interest rates. On the other hand, if the interest rates rise to 7%, then firm B will have to pay firm A 1%, that is 7% minus 6% as the difference between the two interest rates. This is how a swap option works. Now, let us conclude. Swaps are agreements between two parties to exchange sequences of cash flows for a set period. The most common types of interest rate swaps and currency swaps. Interest rate swaps allow parties to exchange fixed rate payments for floating rate payments and vice versa, which can be useful for companies with mismatched assets and liabilities. To successfully invest or trade or to work in the financial sector, it is necessary to learn and understand the ways derivatives like swaps are used. That's all. Thank you for watching the video.